Hello and welcome to the Capital Stewards Podcast. If you've been following the financial news this week, you already know the summer of 2026 is shaping up to be one of the most consequential IPO seasons in a generation. SpaceX is likely set to begin trading on Friday. Anthropic just filed their S1 a couple of weeks ago, and earlier today, OpenAI officially kicked off their IPO process. Three of the most talked about technology companies in history all headed to public markets around the same time. I'm Brian Seay, and like I said, welcome to the Capital Stewards Podcast. Today, I want to do something a little different. Instead of waiting until all the dust settles, I want to talk you through what's happening right now while it's unfolding, because this is exactly the kind of moment where thoughtful investors either make great decisions or they make very expensive ones. So we're going to cover a few things today, how IPOs actually work, because most people think they know, but there are some mechanics that really matter that are kind of happening behind the scenes and aren't as transparent. We're going to talk about what we know about each of these three companies, what I think about their valuations. I'm not going to make a recommendation on whether you should buy them, so I'll just dispel you with that, but I will give you some perspective on what you should be thinking about. And then we'll talk about what history teaches us about buying the hottest IPOs in any era. And then, of course, the big one, what questions, like I said, that you should ask before you put any money to work in these IPOs. So let's dive in. First, let's make sure we're the same understanding of what an IPO actually is. When a company decides to go public, they hire investment banks called underwriters to manage the whole process. The first step is filing what's called an S1 with the SEC. That's the document that for the very first time lays out the company's full financial picture for public scrutiny. Revenue, losses, debt, risk factors, all the stuff. Companies usually file this confidentially at first, but they typically announce those filings anyway, even though the actual document isn't public. So they start building investor buzz. That's what you've been hearing about in the news. Then the S1 becomes public and they start something called a roadshow. And that's where the executives and bankers travel around. You may have seen Elon Musk and Jamie Dimon doing a meeting with investors earlier this week. But they travel around, they meet with big institutional investors, mutual funds, pension funds, hedge funds, all those kinds of things. And then based on those conversations, the underwriters help set an IPO price. And the goal is to find a price where the demand from investors roughly matches the supply of the shares that the company is going to sell. And here's something that's important to understand. So the night before the IPO, the banks collect all the cash from investors in exchange for shares at that IPO price. And here's the part that I think a lot of retail investors miss. To buy shares at the IPO price, you have to have a prior relationship with a broker, Morgan Stanley, Goldman Sachs, Fidelity, Schwab, and they have to give you what's called an allocation the night before the stock actually starts trading. And in hot deals, the demand for those IPO shares exceeds the supply. And one word of caution here, because you think, oh, well, demand exceeds supply, that's a pretty good thing. Because a lot of investors, though, they know that they're not going to actually get everything they ask for in that allocation process. So they inflate their orders. They want 100 shares, so they ask for 500 shares or something like that. So when you hear an IPO is oversubscribed, it really needs to be oversubscribed by a lot, like 7 to 10 times before it's genuinely meaningful. So if something's just 1 or 2 times oversubscribed, that can just mean investors were padding their orders. That's not necessarily something that's going to indicate a really good trading day after the stock goes public. So after the night before the IPO, the investors that are investing in the deal get their shares, and then the IPO starts trading around the middle of the next day after markets open. It doesn't happen when the market opens, happens generally in the middle of the day. The exchanges work to make sure that there's kind of this matching process that's happening before the shares actually start trading. And a good IPO day is generally when the stock trades 5 to 10% above that IPO price. That means the investors who bought in the offering are happy, they made a little bit of money, and the company that was selling the shares didn't leave too much money on the table by pricing their shares too low. And if you don't have an allocation before trading starts, and most individual investors won't, then this is when you're buying shares on the open market after that price has already started to move. So being thoughtful about whether and how you want to participate in an IPO is really, really important. So let's talk about these three companies and their processes. So what do we actually know? So SpaceX is the furthest along. They filed their S1 in April, made it public recently, and they've started their roadshow. And they're going to price the shares at $135, and the stock is expected to start trading this coming Friday. Goldman Sachs is leading a group of 21 banks on the underwriting. There's some confusion. Maybe it's Goldman and Morgan Stanley. Nobody really knows, but something like that. The financial story for SpaceX is pretty compelling. In part, SpaceX did about $18 billion of revenue last year. That's up 33% from the year before. So good growth. Starlink, which is the satellite business, they call it the communication segment, contributed about $11.4 billion of that revenue. but they also lost $4.9 billion last year. And to really understand the valuation, you got to separate these businesses. So that Starlink connectivity set generated about $7 billion of EBITDA. That's a rough proxy for profitability or cash flow. And then SpaceX takes all that profit that comes out of Starlink and they reinvest it into the space and the AI businesses, which are still burning cash heavily. They're actually burning more than $7 billion. That's what the loss is, and hence need to do an IPO because they need to raise cash so they can keep funding investment in those businesses. So here's how I think about the math. If you assume that Starlink's EBITDA doubles each year for the next 3 years, which would be an extraordinary growth rate, you'd end up with about $56 billion in EBITDA by the end of 2028. At the current $1.7 trillion valuation, you'd be paying about 31 times 2028 EBITDA. For reference, Google, Microsoft, Nvidia trade between 10 and 20 times EBITDA, for the next year or so, 2026, 2027. So you're paying a really significant premium for the belief that all that growth happens and eventually that the space and the AI segments become profitable as well. There's also something a little bit unusual about how SpaceX is being priced. Like I mentioned earlier, they essentially set the price at $135 ahead of time rather than going through that traditional price discovery process on the roadshow. So the real price discovery is going to happen when the stock starts trading on Friday. And that means you could have a lot of volatility either up or down in either direction, because that's where we're going to, as investors, try to figure out what the company is actually worth. So let's talk about OpenAI. OpenAI just formally kicked off their process. And before they could even do an IPO, they had to completely restructure the business. OpenAI, remember, was originally set up as a nonprofit, largely funded by Elon Musk. And a nonprofit obviously can't issue public shares. So they completed this transition to a public benefit corporation last October. And then they endured a big court battle with Elon Musk over this past year about whether that conversion was properly handled. And they got the go ahead to proceed. So the revenue growth for OpenAI is pretty staggering. They went from about $2 billion in revenue at the end of 23 to over $20 billion at the end of last year. So that's a lot of growth. ChatGPT has around 900 million weekly active users. It's one of the fastest product sort of adoptions in consumer technology history. The concerns, though, here are pretty significant, right? OpenAI is deeply unprofitable. Media reporting, so we don't have a public S1 here, so we just have sort of what people have heard around the company. But media reporting suggests they lost about $9 billion in 2025, and they expect losses to approach $74 billion by 2028 before they even start targeting profitability in the early 2030s. That's a long time to wait for cash flow. And then there's Microsoft and the relationship that they have with OpenAI. Microsoft has invested about $13 billion and owns 27% of the company. There's a $250 billion Azure services commitment baked into that relationship. So before you buy the OpenAI stock, you really got to understand sort of what the economics actually look like for public shareholders after Microsoft position is accounted for. And that'll be something we can probably find out more about when that S1 comes out. Anthropic, the third company here, most recently filed. They submitted their confidential S1 on June the 1st. And originally we thought maybe that listing would come this fall. I think it's probably likely to follow SpaceX over the summer if the market is receptive to SpaceX. That valuation is likely also going to be north of $1 trillion. They just did a private funding round at $965 billion. So if the IPO isn't higher than that, those investors are going to be unhappy. The revenue growth for Anthropic also has been pretty remarkable. Media reports suggesting that they're approaching $50 billion in annualized revenue at the end of May. And that's largely driven by enterprise adoption, right? The growth of Claude Code and businesses buying other Claude products and buying other Anthropic products. And I think that's a distinguishing feature for the Anthropic business model, right? About 80% of their revenue comes from businesses as opposed to consumer subscriptions that you see for Gemini and for OpenAI. Enterprise revenue, business revenue, it's more predictable, it's more defensible. Data from the expense management firm Ramp shows that Anthropic's share of their business customers jumped from 9% to 34% over the past 12 months. So that's pretty good growth. But there's risks here too, right? Anthropic has massive compute commitments, right? Tens of billions of dollars contracted with AWS and Google, Azure, and SpaceX, ironically. So they need that high growth to continue to cover those costs. The other thing to think about with Anthropic is they have this kind of safety first mission, and that's cost them commercially. Most notably, they appear to have sort of passed on some pretty significant Defense Department contracts earlier this year because of their safety principles. And that's admirable, but there's a real financial consideration to whether or not that's the right thing to be doing or not. So before we get into the sort of practical questions that you should be asking, I want to spend a minute on what history actually tells us about IPO investing, because the data here, I think, is really instructive. The most important lesson, I think, is that trading the day of an IPO is closer to gambling than investing. Microsoft, Amazon, and Nvidia all popped on their IPO days. Great for everybody. Google and Meta did not. But here's what all five of them have in common. The real returns, that sort of life-changing compounding, happened really years after the IPO, more than a decade later. So if these businesses are really great investments over the long term, being in or not in on the day of the IPO is not going to do that much to your long-term return potential. I'll break it down a little bit more. So Amazon, talking about Amazon for a second, they went public in 1997 at $18 a share. For the next few years, investors called it Amazon bomb. The stock crashed. But investors that held on through that or bought after the crash when everybody else was running away, they were rewarded with one of the greatest sort of returns in the history of the stock market. Google's IPO was a disappointment at the time. They had to cut the price target to around $100 from $135. And it started trading there, around the first day. And today, obviously, Alphabet is one of the largest companies in the world. So not a great first day, but has compounded significant value over time. Meta is another cautionary tale. It was public back then in May of 2012 when it went public, $38 a share. I remember I was around for this one. And, really, I think at the time we were encouraging clients not to participate because, the business itself, while a lot of people were on Facebook, its ability to generate cash was really unproven at the time. Nobody really knew how Facebook was actually going to make any money. And there were some technical sort of malfunctions at the NASDAQ that day. I think those have probably been dealt with now, so I don't know that those are relevant for us. But there were some issues on the IPO day for Meta. But basically, it opened at 38 and it closed at 38, and they had a lot of underwriter support to sort of prop the stock up. But 3 months later, the stock was trading, around $18. So it got cut in half, or really more than half. It took a long time for it to come back. But here's the thing, Meta wasn't a bad business. It turned out to be one of the most profitable companies in American history. If you paid $38, for Meta shares, you'd be really happy today if you held over the long term. So good companies, good investments are not necessarily the same thing, and the price that you pay matters a lot. So how should you think about these investments as a steward of your resources? So let me walk you through a few things that I think are sort of non-negotiable when you're evaluating an IPO. So first, valuation is not a technicality. Okay, it's not just something that people sort of come up with, right? It's really everything when you think about what your long-term return potential is. At 177 or at 1.7 trillion, SpaceX, like I said, is priced at 95 times last year's revenue. OpenAI will be priced about 65 times revenue. For context, Google trades about 10 times revenue. Microsoft trades about 10 times revenue. Even high growth Nvidia trades about 20 times revenue. So that's not necessarily wrong. I mean, it's possible that SpaceX and Anthropic and OpenAI could grow into their valuations, but everything's got to go right for a long time for you to earn the kinds of returns that you're going to see. That's a very long list of conditions. Second, profitability matters, I think, more than excitement. All three of these companies are currently unprofitable. You're being asked to pay for a future that hasn't arrived yet. Anthropic has the clearest near-term path to positive cash flow, maybe 2027 or 2028. OpenAI's path, they've got to resolve some really significant structural questions. How do you get consumers to pay up and fund their continued growth? They've also got the Microsoft economics to sort of deal with. And then third, governance, right? So Elon Musk for SpaceX is going to continue to be in control of that entity, even though it's a public company. So public shareholders, you get all the economic exposure, but there's not a board that's working on your behalf the same way that there would be at a company that has a more broad base of control. So, and that's pretty typical, by the way, in founder-led companies that go public. It worked fine at Alphabet and Meta, So it's not necessarily a reason not to buy, but it is something for you to think about. So, fourth, position sizing. The right question isn't whether SpaceX, and particularly Starlink is a good business. It probably is. The right question is, how much should you be, investing in it? How do you size the position that you're going to put into, one of these companies when it's at its sort of peak fervor, peak excitement level? really investing in an IPO is speculation, right? It's a speculative position. And so, if you're investing more than a couple of percentage points of your portfolio, if something does go wrong, you're gonna be disappointed that you did that. And in reality, unless you've got hundreds of millions of dollars invested with an underwriter, you're probably not going to get a huge allocation anyway. So you're probably going to be pretty limited to the size of a position that you can own to start with. Fifth thing, don't underestimate the lockup and industry dynamics. So insiders, when we take a company public, the folks that are selling shares generally are locked up for 180 days. So they sell some shares at the offering, but then they can't sell any more shares for a while. But all those employees of the company, man, they've got all that wealth on paper now. They've got all those publicly traded shares and they want to sell them. And so once that 180-day lockup expires, a lot of selling will follow. So you've got to keep in mind what's going to happen when, a half of a year from now, so maybe around the end of 2026, early 2027, when those lockups expire. And then, SpaceX is a little bit different because instead of doing a 180-day cliff, they're going to have some lockups that are going to expire over time over the next couple of months. So you may see some selling pressure as those lockups expire over the next few months. And the other thing to think about is index demand, right? So the NASDAQ has said, they're going to move to include SpaceX, and they probably will do the same thing into their indexes pretty quickly. Normally, we see this process of 12 months to a year before that happens. And so that's going to create like $20 billion of automatic buying. But I'm hearing a lot of folks talking about that. Index inclusion is going to provide all this price support, and that's going to be great, but it's not a magic bullet. NVIDIA trades about $31 billion every single day. So index demand will help at the margin, but it's not going to override weak sort of underlying fundamentals. If anything, it's going to maybe offset some of those lockups that are happening throughout the rest of the year. So keep in mind some of the dynamics of IPO trading. It's not just do you buy it today, but you've also got subsequent rounds of selling as those lockups expire, and you've also got indexes that are going to buy. And I think the bottom line, right, is that patience, I think, is a competitive advantage to IPO investing, right? Some of the best entry points in these companies might be 6 to 12 months after the IPO, might be the IPO price, you don't know. But, you could get a good entry point after a lockup expires, after the dust settles, after a few good quarters of public earnings reports. So just be thoughtful about the timing of investing in some of these companies. So, all right, before I wrap up, I'll leave you with 6 questions you should think about and work through before you decide to actually invest in any of these, over the next couple of days or through the balance of the summer. So first, what are you actually buying, right? You have to do the work. You have to read the S1 because you're not going to get a lot of analyst reports on the companies because they're not public yet, right? 2, what does the valuation require, right? And to that, I like to work backwards, right? If we're going to pay 1.7 trillion for SpaceX, what has to be true for that to be a good valuation? And do I believe that those things can happen? 3, how does it fit into your portfolio, right? Can you afford to lose money either entirely or, a lot of it if the stock goes down 20, 30, 40% pretty quickly? And if losing is going to meaningfully change your financial outlook, maybe you're putting too much into an IPO. 4th, are you buying on the fundamentals? Are you buying on a sort of investment thesis, or are you buying on FOMO, right? Are you buying on the fear of missing out? That can be one of the most expensive emotions in investing. So if you're buying on FOMO, you should think about that and maybe not do that, right? And then 5th, what's your time horizon and exit plan? You don't have to answer, before you buy, but you need to think about, right? Am I buying this for a few months, for a few years? Hopefully not for the IPO day, because if you're doing that, again, you're gambling. You're sort of hoping that things are gonna work out okay. But what's your exit plan? And then 6th, have you thought about taxes, right? So if you're going to buy the shares and then flip them even a few months later, you're going to pay ordinary income taxes on that. So, somewhere between 20 and 30% of those gains are going to go to the government right away. So in closing, SpaceX, OpenAI, Anthropic, they're genuinely consequential companies, right? Technologies they're building, reusable rockets, frontier AI, satellite internet, all that stuff has, real transformative potential. And I don't think anybody should be dismissive of any of those things, but we've been here before, not with these specific companies, but with this specific moment. It's the moment when the excitement is at its peak. Everybody feels like they're going to miss something historic if they don't act right now. But what history, I think, consistently shows is that the investors that do the best are the ones that slow down, do the work on valuation, and then decide if they're going to be committed for the long term, because that's really where the value is going to get created anyway. Good stewardship, it doesn't mean sitting on the sidelines, right? But it does mean being intentional. It means that you got to understand what you're buying, why you're buying it, and what price it makes sense, and being honest with yourself about the differences between a great company. All of these may be great companies, but great companies are not all great investments. What's the difference between those things? And what's the difference between investing and gambling on day one price moves? So if you want to talk through any of this in the context of your specific situation, how these IPOs might fit or not fit into your plan, I welcome that conversation. You can connect anytime through the website. There's a link there. You can schedule a conversation right on the front page of the website. So thanks for listening, and we will talk soon on the next episode of the Capital Stewards Podcast.